We have with us the brains trust of Motilal Oswal, and why? Because this is the curtain raiser to the 14th annual Global Investor Conference of Motilal Oswal, often a much watched event. And I have with me, as I said, the brains trust Gautam Duggad, Navin Agarwal and Rajat Rajgarhia. Gentlemen, thank you very much. But before we get to the conference, day after day, we at CNBC-TV18 are very happy to announce that the Nifty is at new highs. Just a few days back, 11,500 scaled, now 11,600 scaled. So let me start over there, Rajat. If we are at this level, I saw your earnings forecast. Your Nifty earnings forecast is a 21% rise perhaps in the current, or a 20% rise in the current year to 547. And next year you are expecting a further 26% rise to about 688. But is not all that in the price? Even now the FY19 EPS, Nifty EPS, Nifty would be trading at some 21 times. Are we not richly valued?
So I think there are two ways to look at this. First, if you look at our earnings, we have been actually growing at a rate of about 15 to 16% for the last many quarters. But these numbers get distorted because of couple of corporate lenders and adjustments from couple of PSUs, because of which the reported growth sometimes looks as low as 5 to 7 and the forward numbers looks as high as 20 to 25. But more importantly, the underlying growth rate has reverted back to about 15 to 16%. That's a welcome sign, right? Secondly, I think the markets are right now partly reflecting the optimism that it sees from the recovery in this earnings cycle. You may look at markets at its all-time high, but aren't they what they are supposed to do? Because as a country, if every year your GDP keeps growing, makes a new high, if your earnings growth keeps growing at whatever rate but makes a new high, so the markets will just follow some of these matrices with its own share of volatility, right? So I think when you look at forward multiples, the markets may look at above the long-term average multiples, but the earnings growth cycle is what it is more excited about right now. And as we have seen the disappointments in the last 7-8 years of down cycle, we may be up for surprises in this up cycle also. Okay,
I just want to persist with you, Gautam, on this point. See, it's your report I'm reading, and you are saying that Nifty is trading at a forward P of 18.8 times, and this is at a 21% premium to its long period average. The Nifty price to book is at 2.8 times, and that is 8% premium to long term average. While it has every right to be at new highs, does it have a right to be at this high highs?
So there are two ways to look at it. When you look at averages, there are always some distortions. Look at Nifty composition, how it has changed in the last 7-8 years. You used to have telecom, capital goods, oil and gas at 8 to 10% weightages in Nifty those days. Today you have 80% of the index comprised of private banks, financials, consumption, auto and IT, right? Now these are sectors which always trade at a higher P than the cyclicals because they have a higher ROE and slightly more structural trajectory to their growth. So while from an academic viewpoint you can always compare the averages of today's P versus 10-year averages, given the way the Nifty composition has changed in the last 10 years, those averages are not as relevant today as they may be 5-6 years back. That is point number one. Point number two is, when you are at an inflection of earnings, see today I am far more confident on earnings recovery at any given point of time in the last 3 years than I was. If you look at the commentaries of corporate lenders, which have been the biggest disappointment, by the way, if you look at Nifty earnings growth itself for last 3 years, excluding these 3 banks, so you are still looking at 47 Nifty companies put together. The earnings growth was 10% in FY16, 17% in FY17, 10% again in FY18, and we are projecting it to be 17 and 18%. So the numbers 21, 26, while they look disproportionately high, they are bumped up because of the extremely low base of these 3 banks and of course Tata Motors also. So market will obviously precede the earnings up move, and that is what we are seeing. You have seen the rally extend after the last quarterly result season got over despite so many worries on the global front, Turkey, currency, crude oil, global trade war concerns. So market is climbing a wall of worry because it is forcing an earnings recovery in a lot of sectors.
add to Gautam's point, you are looking at a P multiple of 18.8 times, which is a 21% premium, right? But if you look at the, what is PE? PE is market price divided by profits, right? The profits in FY18 for the Indian corporate sector is at 3.6% of the GDP. Over the last 15 years, this number has been over 5%. And at the peak, this was at 7.8%. So the profit base, because of the way corporate lenders have behaved, because of the way pharma sector has behaved, capital goods sector has behaved, and sector after sector has behaved, is at a 15-year low. At a 15-year low, if you look at the market cap to GDP now, we are trading at about 80%. The market cap of all companies in India is 157 trillion, which is 80% of the GDP of India, which is where it has been for the last 15 years. And the peak of market cap to GDP for India is 150%. So we are half of that peak. Just gives you a context of, you know, whether we are richly valued in the context of normalized earnings. You're looking at reported earnings just for 1 year. If you were to normalize the margins or the corporate profit to GDP, then the valuations may look less richer than the 21% premium that you alluded to.
Fair point. That's extremely well argued, but now we want to go from averages to specifics.
Correct. So, you know, before I get into specifics into individual sectors as well as what you are going to present at the conference as well. But first, one word on you know, while we spoke about earnings picking up and he's expecting a 20-25% earnings growth, you know, Uday Kotak very nicely put out this year that this is a year when the micros are good, but the macros are going to be challenging. You have crude at 75, rupee at 70, you know, trade war risk. How are you looking at the risk, you know, factors from the market point of view?
I mean, there are clearly these risks manifesting in substantial slowdown in FII flows in the last fiscal year. In fact, in the first 4 months of this year, FII flows have been negative. However, if you look at the DII flows in the first 4 months of this year, it has already been $6 billion, which is a run rate of $18 billion, which is similar to the flows that we saw last year, which was also $18 billion.
That's the reason why markets are supportive, right?
Absolutely. So what I'm trying to say is that there are foreigners who are withdrawing from Indian debt, there are foreigners who are withdrawing from Indian equities, because to them, Indian macro is concerning compared to macros elsewhere. However, as far as the domestic saver is concerned, he does not have the same flexibility to move between India and the other emerging markets or between emerging markets and developed markets. And I think as far as the micro is concerned, as Mr. Kotak rightly articulated, that's the one which is looking interesting. Corporate earnings are the ones which are looking interesting, and that's the reason why we see flows continuing in equities, and hence, you know, markets unlikely to see any major correction due to the point on macros that you articulated.
Okay. No, I take your point. For the foreign investor, there are other options. For the Indian investor, probably between asset classes, equity is still a superb option, considering where real estate and gold are. But now, I really want to get to the specifics, especially because it's a favorite sector. ICICI Bank is your preferred pick while playing recovery. But why only ICICI? Okay, you also have BOB. But I mean, a corporate lender would also be Axis. Corporate lender is also BOB, and we are seeing signs of strengthening in other sectors, in other corporate lenders as well. So would you increase your basket as you see these banks perform, or are you sticking to these two?
So 2 points you missed. If you see my model portfolio, there is SBI also and there is S-Bank also. So there is SBI, ICICI, S-Bank, which are part of my model portfolio. What you are looking at is perhaps the quarterly top idea share.
Yes.
So as you rightly mentioned, we are seeing a big turn, at least as far as commentary is concerned, on the corporate lenders. I think give a quarter or two here or there, you are seeing a upturn in the corporate asset quality. Obviously, as you have seen the commentaries of most of the banks and numbers, slippages, all of those things put together, if you see the key operational indicators, it seems that worst is behind as far as that part of the bucket is concerned. Secondly, if you see the stock price movement itself over the last 45-50 days, ever since the results started pouring in from corporate banks, you have seen that some shift has happened already in the portfolios from richly valued private retail banks to incrementally towards private corporate banks. You have not seen a big bang, shift towards the PSU corporate lenders, which are on the mid-cap side. So yes, it is possible, but from a longer term perspective, from a 3-year, 5-year, 10-year point of view, I still think that the value migration potential which a lot of these private financials offer, that is too huge to be ignored for a 6 months, 12 months tactical shift in the portfolios which is happening in favor of corporate banks.
Okay, that's about banks, but we have to take a break. I'm coming back and asking you about the private NBFCs. That seems to be a growing sector. So more on that from the Brains Trust of Motilal Oswal. Welcome back to the curtain raiser to the Motilal Oswal 14th Annual Global Investor Conference. We have been speaking with the Brains Trust of this company. Before we went to the break, Gautam, we were talking about the banks and how you're betting on corporate banks. But the new growing space seems to be NBFCs. So give us an idea. Do you see that increasing its command in your top 10 or your top 30?
It has already happened. If you look at the profit pool of my universe, NBFC's profit pool today is 33,000 crores, sorry, 28,000 crores,
okay,
which is almost approaching the consumer profit pool of my universe, which is at 33,000 crores. 5-6 years back, this was unthinkable, right? So as you see the proportion of profit pool rising in favor of NBFCs, secondly, what has also happened is the space has opened up because of the stress in public sector banks. So the opportunity is huge, the size of prize is very big. And a lot of these NBFCs which have done well over the last 3 years, 4 years, they have a lot of room to still grow. And that can happen. So you will see the list of top ideas or list of preferred picks incrementally moving away from banks to not just NBFC, but if you look at the entire financial sector itself, you have insurance which has got listed in the last 12 months, that has opened up. AMC has opened up. So the entire financial space which used to be just banks, private sector and PSU banks 10 years back, today you have a choice of plenty, and that's where the job of a capital allocator has become a little more challenged when he has to allocate the money within financials.
Rajat, I was looking at the long list of corporates which are going to be at the as keynote speakers at the conference. Clearly, there are names across the board. There are some people who believe that there is now bubble getting created in the consumer names, 50 times, 60 times, 70 times valuations. Is that a bit of a concern for you, given that a lot of the consumer names are too much over-owned, and there is a bit of a valuation concern as well now?
So Nimish, this question may have been valid at any point of time over the last few years, just that the valuations are getting richer every year. So I think one of the obvious worries is valuations of 50, 70. In fact, we recently downgraded a couple of companies which are trading at 100 times trailing PE multiples, right? I think some of these stocks are okay if they don't give returns for 1-2 years. But many of these companies are probably growth models for a much longer time. And investors who are owning these stocks are probably okay with not earning anything for 12-18 months and still okay to earn a low double-digit return over a longer period of time. You may not find many of these stocks in our house model portfolio, right? But I think there are bunch of investors who are still very, very believers or loyalists to these kind of investors, right?
Right now, where you see the highest level of conviction in terms of if somebody wants to invest into equity markets at this point in time?
So I think you will typically make great returns in the market if your buying price is right for good companies, right? So our model portfolio reflects many of these changes, but a couple of things we are very positive upon. Companies which have failed to deliver any profit growth because of external environment or specific reasons to them, when they come out of that phase and start growing up, right? Typically investors forget how to value these companies because last 5 years you have only met disappointments in them.
Just to take your point forward, Rajat, on the cement space, because you spoke about that's one space which really saw some solid numbers coming in from the likes of ACC, Ultratech reporting strong numbers, but still valuation, I mean, people are not giving that kind of a valuation. Is that a space where investors will make money?
So cement is generally an alpha sector because the weightage of cement in all the indices are pretty low or very negligible, right? And in the right companies or the right growing companies, investors have made a lot of money in the last 5-7 years. If you look at companies like Shree Cement, Dalmia Bharat, people have compounded returns massively, right? I think from here onwards, we surely think that the cycle will only get better because it's long time that demand should start picking up, and supply, you can forecast supply for sure, because you know what is going to get added in the next 3 years. And I hope that all of these initiatives about housing, infra, industrial activity, which we have started to talk about more positively now, right, should lead to a better cement demand, right. So I think this is a deep cyclical space, right. Valuations don't matter whenever the cycle turns up or down, right. We have seen the down cycle now. Hopefully the up cycle should be very time soon.
Okay, which brings to a question which everybody keep asking us as if we know too much. Is it once again time to buy the mid-cap and small-cap funds?
Let's take Nimish's question to Rajat on cement sector. If you look at the bashing that the large-cap cement stocks have seen, it is very small or negligible. But if you look at the bashing that the small-cap cement stocks have taken, it's almost 50%, and in some cases even more, with solid earnings growth visibility due to capacity expansion over the next 2 to 3 years. There are maybe at least half a dozen names like that. This is just one example, but I think this example straddles across many other sectors also, and we do believe that the current valuations of some of the small and mid caps, and you have to be bottom up when you talk about small and mid caps, do offer much better return prospects than the large cap Nifty index or the Sensex.
Rajat, I want to ask you on banks, which probably Lata would have asked you. We are going to see a lot of change in terms of heads of larger banks in the next 12 to 18 months from now. Whether it's Yes Bank, IndusInd Bank. Obviously there is a report about Axis Bank having a new CEO. How's that space looking to you? Because I believe in the past you'll have betted on something like RBL or AU Finance. Within that banking space,
betting on people,
so to speak. Generally, what's your sense there? I mean, where you think investors will still make a lot of money?
So I surely think that investors pay a very premium multiple to the managements of these private banks, and that has played very well for the last 2 decades. In fact, some of the banks' identity is with the top guy running that show for a long time, and it is, I have not seen since 1994 this level of wholesale changes happening in a period of 2 years, right. I think it is going to be an event to be watchful for, right. From a strategy point of view, you have the next rung of private banks which are coming up. There are 2 things in their favor. First, their market share is today so small that in a growing profit pool they can keep growing at 30% for the next 5 years, and the managements are still young enough, either in their late 40s or early 50s, to run those banks for at least a decade plus. And I think that is where we have started seeing investors allocating more money, also reflecting in their stock prices. The names that you mentioned, RBLs, AU Bank, couple of more you can add in that.
You saw a big block of 9% getting sold out
in that bracket. So I think there is enough till the time these banks keep growing, outperforming the sector growth rate, they will remain premium. And I think some part of investors' allocation from the top 4 or 5 may shift partly to these, in case you want to see a better return profile over the next 3, 4, 5 years.
Okay. Gautam, I want to ask you the tomorrow sector. Is pharma one of them? Or even worse, what performed absolutely the worst over the last 5 years? Real estate.
No, so I think I would agree with pharma, because what has happened in pharma over the last 2 years, if you just see the spate of earnings downgrade, and I'm not talking about mid caps, I'm talking about the top 5 large pharma companies. In last 6 quarters, the earnings downgrade has been anywhere between 35 to 50% for each one of them. Most of the bad news seems behind now. In fact, the flow of bad news itself has moderated. Secondly, optically, you have a 6 quarters of double-digit earnings decline in the base, which will correct. It has already started correcting. For the quarter that ended, we saw 35% kind of a profit growth. So I think this is a time where somebody who has had a significant underweight position on the pharma, perhaps it's a time to relook at that. And pharma is a sector which is very complex. Each company is very different, unlike say an IT, where it's a very universal kind of a operational trends. So one has to be very bottoms up in pharma. I am more gravitating towards the large cap side of the pharma right now, because I think earnings growth can come back and the flow of bad news that we have seen has stopped. Secondly, valuations are already quite juicy now. after having seen a 35-50% knockoff in the last 2 years. So pharma is one sector where I think we can see some positive surprises emerging over the next 1-2 years.
A final question to you, Navin. What are you looking forward to in this conference? What is the main theme you will want to hear?
Actually, over the last 13-14 years, many of these leaders have been able to show us tomorrow today. And the brief to most of these leaders is not to really give us an update on their businesses or their companies, but to share with us their vision, long-term thought processes, ideas. And I, for one, have always come out really benefiting out of that tomorrow's idea coming out today from some of these thinkers. And I'm looking forward to the same again. I mean, life insurance space, general insurance space, private financials, NBFCs, public financials, consumer, politics, we have almost everything out there in a space of 3 days. And I think we will have definitely at least 2 of the best performing, I mean, this is the record I've been monitoring for the last 5 years. You will have at least 2 of the best performing large cap ideas that usually come out of this, and I've seen this consistently for the last 5 years. So looking forward to that hunting in that maze of thinkers, over the next 3 days time.
And we wind up this conversation. Thank you very much for joining us in this chat.